We've got the market agenda to discuss this morning because a lot of things going on this week. We got bank earnings, we got inflation data. Joining us right now to talk about all of this is Alli McCartney, Managing Director at UBS Private Wealth Management, and also, I should say, founding partner of UBS's Alignment Partners. Good morning to you. I think we're all trying to understand, we're going to be getting these bank earnings later this week, which may be the barometer. I don't know whether you think this is going to, so goes the banks, so goes the rest of the economy at this point. But I think a lot of focus will be on J.P. Morgan and some of the other banks. What are you looking for?
It is possible that what we see in 2026 is the third year of bank outperformance. Credit to Eric and Nigerian, our banking analyst at UBS. That has only happened in recessionary years or years after recession. And it's usually characterized by three things happening in the market. The first is accelerating loan growth, which we are seeing both on the demand side from decreasing interest rates and on the supply side from regulatory reform and releases of the SLR, the strategic leverage reserves. The second is increased M&A activity, which we are also seeing. And the third is a steepening yield curve, which whether we ultimately see because of a bull and a bear steepener and not just decreasing short rates, we're also in. So, it is very likely that we see very good numbers out of the bank. I think, as you said, so goes the banks. It's an arbiter not only to the consumer, but especially this year with a lot of dampened activity in corporates, both with sort of a closed M&A and IPO pipeline, but also because there was really a paralytic stance as a result of the first year of the administration and tariffs last year. So we think what we're going to see is, real big bank earning bonanza out of the gates that's going to set up for potentially third year of bank outperformance and put some stability in terms of tailwinds in this micro and macro economy.
Prior to the segment, we were talking about AI. There's a whole group of folks who think that the banking sector has a huge opportunity because of AI in terms of cost savings and almost transforming their business into tech companies. I've heard this increasingly from a whole number of bank analysts, and I'm curious whether you're thinking about the banking industry in a very different way than you used to.
I am hearing the exact same thing, both from the analyst community, but also from the many clients I have who have different both sort of sales and management positions at banks. I think it is absolutely true, and it has been the case in the past that a lot of technological innovation and reform has not only hit the consumer sector, but has hit the financial sector first. Jamie Dimon was one of the first to mention, I think 2 quarters calls ago, what they're seeing in terms of advances with AI, in terms of producing pitch books, et cetera. There are definitely increased efficiencies, not only in the banks, but it's definitely starting to bleed out into the broader economy, into other sectors. One of the things that it's interesting is, as of last Friday, slightly less than 20 companies had pre-released for this earnings season. And of those companies, which covered most of the sectors in the S&P, first of all, earnings were up about 14%, and revenue was flat. So what we're talking about are increases in profitability and margin. That's clearly not all due to AI, but I think we are really starting to see that evolution and revolution of the permeating of productivity and marginability. Ultimately, for the banks, just like for any company, there's going to be the sort of intersection and the rub of being the most efficient from a profitability perspective, plus maintaining corporate culture and growth of your human capital as well as your capital.
Okay, before we let you go, you want to weigh in on the Jay Powell of it all? How much of this matters, do you think, to markets?
Clearly, markets told us yesterday it doesn't particularly matter. I think that's because of all the things that we just said about the earnings season and the fact that we expect, again, a third year of earnings increasing at double digits. With that, I would say that the people, as you said, that came through yesterday, whether it's Powell, Yellen, et cetera, these are individuals who are very humble individuals with a lot of integrity and respect for the system. And the fact that they are weighing in, I think, is quite meaningful. I think the reason it hasn't yet affected the market is, like with a lot that comes out of this administration, there's a lot of noise, and one has to wait from a trading or an information perspective to understand what the actual end result and effect is, and then sort of price in the rub. Whereas now there's a lot to be concerned about, but it's more noise than it is fact.